Hey, what's up, everybody? Welcome back to Investing Sucks. So, in this video, we're going to be diving into a debate that is certainly one that's going to divide investors in terms of what types of stocks they like to invest in, and that is the debate of which is better, high quality stocks or well priced stocks. So, this debate usually goes something along the lines of one investor buying a company that they believe has a bright future ahead of them. They think that company is a fantastic company, and they cite all the various reasons why they think that. And then another investor will come along and say that their logic is flawed because you can't just buy a company and invest in a company simply because you think it's fantastic. You also need to account for valuation because any company out there, no matter how good it is, can still be a bad investment if you don't invest in it at the right price. So we've all heard this debate before, probably in value investing communities across the internet. So what I wanted to do in this video is explore this a bit more. And what we're going to do is we're going to do a 5-year back test using two very simple investing strategies where one focuses on just buying high quality companies, so no regards to valuation at all, whereas the other only looks at valuation and just looks at companies that would appear to be cheap based on traditional valuation metrics like price to free cash flow, price to earnings, etc. And then once we've done that, I'm going to give you my personal opinion on the debate and then also pull some academic literature on this topic and then see what that says. So without further ado, let's actually dive in. Now, obviously, the first thing we're going to need to do here is we're going to have to explicitly define what makes a company a high quality company and what makes a company a well priced company. Now, there's no set definition of each one, right? It's going to be subjective and it's really going to be up to what I determine. But what I tried to do and what I tried to do when I was determining, the list of conditions that would define each one was I tried to make it something that investors would generally agree upon. So something that was simple but something that also just made intuitive sense so that when people see that list and they see the criteria, they can think to themselves, okay, yeah, I would agree that companies that meet that criteria would generally be considered high quality or well priced. And by the way, if you're wondering what this website is that I'm using here, it's a website that I created called tickernomics.com. The whole point of this website was to basically help investors analyze companies. So we have various analytical tools. You can see we have this list of public scripts, which are all these, analytics here that perform various automated tasks. I've talked about a few of these in my past videos, and then we also just have financial data on companies. If you click the companies list here, then we have 10 years of financial statement data that you can go back and look at. We have ratios, charts, as well as a bunch of other features. So anyone who's been around my channel for a while, you know all about Tickernomics, but in case anyone who's watching this is new to the channel, I just wanted to clarify this website and what it is basically. And one of the things that you can use this scripting functionality for, which does require coding language or coding knowledge here, as you can see, this is the code that I wrote to create this list. One of the things you can use it for is backtesting, which is what I'm going to do in this video. So what I want to do is kind of show you what happens when you run this script now. So this is the high quality companies script. We'll start by first examining the high quality companies and then look at the well priced companies. So here is the criteria. So it generates a list of companies that have ROIC, so return on invested capital, for the last 12 months, so the last 4 quarters, of over 30%, and an ROIC of over 25% in each of the past 5 years. And then they also have a debt to equity ratio below 2. So the debt to equity ratio is really just to eliminate companies that have a lot of debt relative to equity. They might be more risky. And generally, riskier companies you would not really fit into the high quality companies because that large debt balance could pose financial risks and solvency risks in the future. So, in order to just weed out those companies, I had that condition there. The ROIC is really the important one. Now, I personally love using ROIC as a barometer for determining business quality. I think that companies that persistently have high ROIC going into the future, it can tell you that there's something unique about that business. There's something they're doing that competitors cannot copy because, competitors are going to notice when one company has persistently high ROIC, or if companies in a given industry have persistently high ROIC. It means that there's money to be made there because they're consistently generating very strong returns on the assets that they have. They're reinvesting back in those assets and generating even more returns. The business is going up in value and it's succeeding. So clearly there's money to be made there. So people are going to enter that industry, and with more competition, ideally what you're going to see is ROIC going down. Now that's all very theoretical, right? What we want to look at is practical, like what actually happens in the real world which is that some companies are just special, right? Some companies are unique, and these are what we would consider high quality companies because they have this growth runway. This is a term you'll hear value investors talk about, this growth runway where they can earn high returns on their capital, reinvest it back in the business, keep earning high returns on capital. To me, that signifies a high quality business. So let's actually run this script now and generate the list to see what these companies are as of today before we look at what they are in the 5-year backtest. So the way to run it is you're going to click Save to My Scripts here. You select the script called High Quality Companies, hit Save to My Scripts, but I've already done that. So I'm going to go to My Scripts here, and then I'll open up the one called High Quality Companies. So I'll run this now. It usually takes about 5 or 10 seconds to finish running. And this goes through basically all the companies we have on the website, which there's thousands, and determines if they meet this criteria. So it says it's done generating the list, and then we have to go to Insight Tables and then select high quality companies to find it. So it's this one here. So here's our list of companies. There's going to be about 100 of these, and I'll extend the names out. And then in the name, I also included the industry and the sector that it's a part of. And then, so here's the current market cap. I included the price to book ratio as well because I like looking at that too. And this is their current return on invested capital. This is their debt to equity ratio. And then this is the 5-year average return on invested capital. So we can scroll through this and see if there's any familiar companies. Here's Quest Diagnostics. This is one that I've seen talked about a few times in value investing communities across the internet. Philip Morris International, the very large tobacco company. Rio Tinto, and then we can scroll through this and see. Here's Herbalife as well. I talked about this company in a few videos ago. Sleep Country, Lululemon. You get the idea, right? So this is, as of today, these would be considered the high quality companies. So then what I also did was I basically had this exact same list, but on a back test. So you can see this one here. It's called a high quality companies back test. But before we get into that, I want to talk about next what we would consider a company that is well priced. So let's open the public script for that. And so we go back to public scripts, and then I've published both of these. So if you want to, log onto the website and go to public scripts and access these lists for yourself, you can do that. So here's the well-priced one. Now, one thing that was different about the well-priced one is I eliminated companies in the financial services sector. And the reason I did that is because if we look at what the PE ratio that I used, there was a lot of financial services stocks. It was kind of dominating the list. And we can see the criteria that I have here, where the companies have to have a PE ratio between 10 and so under 10 or above 4, and then a price to free cash flow ratio below 10 or above 4. And then I filtered out the financial services businesses because a bank, for example, having a PE ratio of 10, that doesn't necessarily mean that bank is cheap. That's actually pretty average for banks and financial services businesses. So I just filtered them out for this case. So, so why did I choose 10 and 4? Well, 10 just kind of felt like what investors would generally agree on would be a low PE ratio. I think most people, when they see a PE ratio below 10, that strikes them as cheap. And then why I filtered out companies that were below 4 is because if a company has a PE ratio below 4, to me, when I would see that, and I think many other investors, when they'd see that, the first thing they're thinking of is, oh, there's something irregular about this company just in the last year. Like maybe they had some one-time item and other comprehensive income that kind of skewed their income. So now their earnings is much higher, and basically investors are pricing in it returning back to normal, which is probably what's going to happen. Or maybe the company just lost some big contract. So the fact that their PE ratio is so low is well justified and they're not actually a cheap business. That was kind of my logic and reasoning behind this. So it's basically just a PE ratio and a price to free cash flow ratio between 10 and 4. Now, why did I include both? Well, one of the reason is sometimes you'll see a company that has a low PE ratio, and it's really just masked by the fact that the company has high capital expenditures, for example, which capital expenditures, they flow through the income statement, or they flow through the cash flow statement. They don't immediately hit the income statement. They hit the income statement kind of gradually in the future years as those capital assets get depreciated. So it could be the fact that they have very low free cash flow, but they have much higher earnings. So there's a discrepancy there. So investors are actually valuing the business correctly. It's not actually a cheap business. It's just cheap in terms of the PE ratio. But when you look at it on a free cash flow basis, the actual cash the business has to return back to shareholders is very low, for example, because of the high capital expenditures. So in order to account for that as well, that's why I included that metric there. So let's run this. I'll hit save to my scripts, and then my scripts will open up here. So here's the well-priced stocks one, and I'll run this, and then we'll just wait a bit and then see what the results are. So just give it a few seconds, and now we can see, go to insight tables and select well-priced stocks. So we go here to insight tables, and we'll select well-priced stocks. So here are the companies, and we can see there's a little bit less data here, just kind of what the current PE ratio and the current price to free cash flow ratio is. So we can see what some of these companies are. We have the market cap here as well. Chevron is included in this list, which is interesting. They were probably the largest company here. You can see Tech Resources is on here, Mosaic, which is a fertilizer company. Can scroll down. Suncor Energy, interesting. I just made a video on them. So we get an idea of what kinds of companies these are. We've noticed a few energy companies, which I think makes sense given energy just had a cyclically high year. So they'd have low PE ratios because investors are pricing in a return to normal when oil prices go down, which might happen due to recession, etc. So now we kind of get the idea of what each types of companies are. Let's actually look into some of the backtest results. So in addition to creating those two scripts that generate the high quality stocks and the well-priced stocks as they stand today, I also created two scripts that perform a 5-year back test. So I'll go to my scripts here and I'll show you one of them, for example. So here's the high quality companies back test, and it's a 5-year back test. So when I run this, it's basically going to tell me the exact same list of companies, but as of 5 years ago. So whatever all those financial metrics were as of 5 years ago. So we can see it's done generating. So if I go to insight tables now and I select the well-priced stocks backtest here, you can see what these companies are. And we have this column here, which tells us the market cap as of 5 years ago, the PE and the price to free cash flow ratio as of 5 years ago. And then the last column here, which tells us the average annual return. So this is the annual return. So for example, this one, 10.66%, that's 10.66 per year for each of the last 5 years. So a lot of these companies performed pretty well. And what we can also do is we can export this to Excel. So I ran this script, and then I also ran the back test for the high quality stocks list. And then I included the results in the Excel here. So I have some summary data that I want to just run through. And then if I go to these tabs here, this is actually the source data. So this is the data that got exported when I exported it to Excel. So in total, there were 113 companies in the high quality list and 97 in the well priced list. So, pretty balanced there. It wasn't like one had significantly more than the other. So it's pretty balanced. And then what I assumed you would do is purchase all the companies that were in each list at market cap weights, and you held them for 5 years without buying or selling anything. And it's a total return. So that means it includes capital gains as well as dividends, and it assumes you reinvest those dividends when you receive them. So what were the results? Well, the high quality companies outperformed the well-priced companies, and both high quality and well-priced companies outperformed the S&P 500. So that's pretty interesting, I think. And specifically, the high quality companies averaged almost 14% annually. So that is obviously very strong. So that bodes well for that investment strategy. Same thing with the well-priced one, although it did do actually quite a bit worse at about 2.5% worse. It still outperformed the S&P 500 by a decent amount. So that I found very intriguing, right? And it is only 5 years, and we are looking at mainly Canadian and US stocks here. But the fact that, the companies that meet this criteria, perform so well, I think that bodes well for both of these investment strategies. And what was also interesting was looking at the percentage of stocks that lost value versus the percentage of stocks that gained value. So if you were to follow that criteria I talked about of high quality companies, so 30% ROIC last year, 25% ROIC in each of the following 5 years, and then debt to equity ratio is currently no higher than 2, then only 16% of those stocks actually ended up losing any value. All the other ones gained at least some amount. Whereas the well-priced ones, it was still, pretty good at only 22%, but not quite as good as the high quality. And just for curiosity, if you're wondering what the best performing stocks were in each list, what was interesting was the well-priced stock actually had the best performer, which was 374 Water Incorporated. I haven't heard of this company before, but in the last 5 years, this company has done 93.44% average annual return. So that's pretty much doubling your money each year. So that's obviously extremely strong. The problem was this company was a very, very small company at the start of the 5 years. So they didn't really make up much of the total overall result. The best performing company in the high quality had a 36.5% average annual return, which was Cadence Design Systems Incorporated. So, again, not a company I've heard of, which kind of is interesting. It goes to show that the companies that are the companies that perform the best in the stock market it's never the companies you've heard of, right? It's always some unique company that isn't really on people's radar. And then what's also interesting to know is the sector breakdown. So this is going to tell some interesting differences between what types of companies were showing up on each list. So I have the total number of companies here, and then which sector they were in, and then the percentage that made up of the total for high quality here, and then for well priced here. So there was a few differences. The high quality companies had a higher concentration of industrial companies and technology companies and consumer defensive companies as well. Consumer discretionary really didn't appear much on this. There was only one company that appeared in the well-priced category. Consumer cyclical was roughly equal, but basic materials companies, so these would be, companies that produce commoditized products, there was a lot more in the well-priced section, which to me that makes sense because companies that produce something like steel, for example, steel is a cyclical product. It has its ups and downs. So if it had a recently strong year, you could see low PE ratios, low price to free cash flow ratios there. Financial services, obviously, I filtered out financial services companies, so there was zero in the well-priced one. Real estate was interesting. There was only one real estate company in the high quality one, but 11 in the well priced one. Healthcare, there was a lot more healthcare companies in the high quality versus in the well priced. And energy, so kind of similar to what I was saying before with steel, energy had 16 companies appear in the well priced list and zero in the high quality list. So that's pretty interesting. And then utilities, zero, and then only five, and then financial, which this was like a hedge fund type company that was the one company that appeared here. So some pretty interesting differences there. And then if I go look at this, this is basically a distribution of returns under each one. So all of these blue dots represents a return. So this axis here is the annual return, and then it kind of just shows what each one is. I wanted to include this because you can kind of visually look at it and see, what really explains the difference. And what you notice with the high quality one is there's a lot higher concentration of companies kind of in this 10 to 20% range, right? Like it's all there's a lot of companies that are their average annual return is kind of in this area. So it's between 10 and 20% right here. Whereas in the well-priced companies, it's not quite the same. They're a little bit more spread out, kind of in this range of 0 to 20, with a few outliers. Obviously, this is that one company that performed really well, and then there's a few other. There's like an anomaly here. This one that lost 70%. So I think this was pretty interesting to note. But what the key takeaway I would have here is that high quality companies had a lot higher concentration in that, higher digits, so 15 to 20% annual return for those 5 years. So, although the results of this backtest are intriguing, we cannot definitively say that this settles the debate and that the high quality stocks are always going to be better than the well priced stocks. Because at the end of the day, we're just looking at one 5 year period. And backtests in finance typically span several decades and even sometimes several centuries, as well as many different geographies around the world. And if you're consistently seeing the same observation over and over again, whether that's an investing strategy or whatever it is, then you can conclude that there's something to it. And one area of research where this has been done is in the area of factor investing. Now, you guys have probably heard me talk about factor investing before, but I am going to talk about it again because I think it's very important. And like I said, this is where there's been academic research done in the space that is generally accepted as being legitimate by the finance community. So, what is factor investing in case you haven't heard of it before? It's essentially a space in the academic field in finance that aims to identify certain qualities or certain attributes that a stock can have that has been historically proven to lead to higher expected returns for companies that have that quality versus companies that do not. So there are five factors that are generally regarded as being legitimate factors. There's the market factor, which is stocks that have higher betas will typically have higher expected returns. The size factor, which is smaller stocks have higher expected returns than larger stocks. The value factor, which says that stocks with a lower price to book ratio typically have higher expected returns than stocks with a higher price to book ratio. Robust operating profitability, so companies that have more robust operating profitability typically have higher expected returns than companies that do not. And then conservative reinvestment policies, so companies that invest back into themselves conservatively as opposed to aggressively tend to do better over the long run. So, why am I talking about factor investing? Well, because this relates to the debate of high quality versus well priced. And what it shows us is that there's really no definitive answer because you could say that the existence of the value factor would mean that well priced stocks, in terms of the price to book ratio, should generally be better if tested over the extensive data sets that factor investing has been tested on. However, there's also something like robust operating profitability, which I would argue is something that signifies high business quality, right? Because if a company is able to stay profitable for extended periods of time through, the ups and downs of the business cycle, then I would consider that to be a high quality company. So there's an elements of both in factor investing. And my personal take on this is I don't necessarily believe that one strategy is better than the other. And I do think that there is merit to both. And it's interesting because as value investors, right, we're taught that price is always what matters, right? And if you're overpaying for a company, even if it's a high quality company, that's going to yield poor results for you. Whereas growth investors, for example, may argue that your number one priority should be on the high quality companies. And if you can identify high quality companies, then valuation just doesn't matter. Which to value investors, that sounds absurd, right? That sounds like it makes no sense at all. But there actually is a little bit of merit to that. There is a little bit of truth to it because let's take a company that is objectively a high quality company. And the company I'm going to use for this example is Walmart. Walmart has been a high quality for many years. Walmart went public in August of 1972, and from pretty much from the time they went public, you could say for the next decade, at any point in time there, you could have looked at Walmart, you could have analyzed Walmart. Maybe you would have determined that it's a high quality company and you could have invested in them. Whether or not you invested in them at their current price at that time back in the 1970s or the early 1980s versus if you invested them at 50 or 100 or 200 times their earnings, which would have been way higher than what the business was actually selling for back then. Because again, people didn't know Walmart was a high quality company back then. You could have purchased it at those, astronomical valuations. And if you held the stock until today, reinvested your dividends along the way, you would have had amazing returns. So if you are able to identify high quality companies like that early on, then there is some merit to the statement where valuation really doesn't matter. What matters is the high quality companies, because if you identify a high quality company, it'll do well regardless of what you purchase it at. However, there are extremes to that, right? Because, and really what the extreme in that comes down to is the fact that being able to identify a high quality company like Walmart that far in advance is more akin to winning the lottery than anything. I mean, realistically, you can't expect yourself to be able to do that because Walmart is currently one of the largest companies in the world. There's not many companies out there that are as big and as influential as Walmart, and being able to identify them as that, decades in advance, it's just not reasonable to think that you can do that. So that's why I think for the average investor out there, you should always be concerned with price. Even though you can point to specific examples where price really didn't matter, again, you can't assume that you're actually going to be able to identify those companies because it's just extremely unlikely and more down to luck than anything. So for the average investor out there, definitely 100% price matters. Do not overpay for a company, even if you think it's a high quality company. And I don't necessarily think that following one strategy is better than the other. I think at the end of the day, if your focus is on buying what you perceive to be high quality companies at good prices, or even being able to buy a bad company at a really, really attractive and cheap price. You can even pull that investing strategy off. There's many different ways to go about it. So that pretty much does it for this video, guys. I wanted to thank you for sticking around, and I hope you did find this useful. If you did, then leave a like, and if you're new to my channel, I'd appreciate it if you would consider subscribing, and I'll see you guys in the next video.